So everyone, thanks for coming to this next session. For those of you who didn't meet me yesterday, I'm Jim Narron. I'm the first Vice President and Chief Operating Officer here at the Philadelphia Fed. Again, thanks for coming to this session. You know, I think between yesterday and today, one of the sort of recurring themes that we've heard both from our experts and that we've seen over the course of the conference is that, on one hand, tech is absolutely disrupting everything, but I think we've also heard that, on the other hand, really tech has been disrupting everything since the Bronze Age took over the Stone Age. I think the point is that, when you think about that time period, it's just happening much faster than it had before. The degrees of transformation that we're seeing that used to take decades or centuries, are now taking place over the course of months or even weeks. And to some degree, our next guest has really watched these epochs unfold since he started his first company that would become PayPal in 1998. And just to give you some context for the span of huge innovation that we're talking about, in those 2 decades. When that started, we were encrypting data over PDAs. Now, for those of you who are young in the audience, PDAs aren't public displays of affection. We're talking about Palm Pilots here. This is how far back this innovation goes. So Max Levchin doesn't need any formal introduction. Everyone here in the audience, knows who he is, and for really anyone living in modern society in America, it's almost impossible to get through your day without interacting with something that he's either had a hand in creating or bringing to market. Though I'll say, Max, that not all of those things are absolutely beloved or entirely. So for full transparency, it's important to note that Max is also largely responsible for CAPTCHA in our lives. So to paraphrase John Mulaney, part of the reason you spend a lot of your day convincing a robot that you're not a robot, just so you can look at your own stuff out there. But since Max has agreed to sit down with us today, we're going to overlook that part and focus on the insights he brings to the journey of online payment and credit from PayPal to Affirm. And who better to moderate a discussion on the next wave of lending than one of the foremost experts on consumer finance. So please, everyone, help me welcome Max Levchin, CEO and founder of like half the internet, and Michael D. Calhoun, President for the Center of Responsible Lending. Gentlemen, thank you.
Must have been the best intro I've ever gotten in my life.
Well, I feel a little bit like I won the conference raffle to get the chance to do this. And also coming from Washington, D.C., for those of y'all who didn't notice, home of the world champion nationals, I feel a little bit like I'm throwing batting practice to Soto and Zimmerman, and my job is to serve them up and get out of the way. And then perhaps my greatest value add to the conference is Max has very generously agreed at the end to take questions from the audience. And I think that'll be richly rewarding. And so think about your questions there if we don't cover them. So going back to the introduction, it's been a significant time span between start of PayPal and start of Affirm about 7 years ago. Can you share some, first of all, with what you learned from the start of PayPal, and then we'll shift to Affirm and the more recent events?
Sure. I'll also try to give a personal and market perspective. And so just to give you a sense, PayPal, I was fresh out of school, 22, 23 years old. I'm now, let's call it 2 decades later. At the time, one of the greatest unsolved problems on the internet was can't really pay anyone. And so You can think of e-commerce and subscription services and content purchasing and every imaginable way. I mean, at this point, most things we do online is we buy things on it. So prior to PayPal, it was that whole thing was blocked, and it did not really matter how good the product was. It didn't really matter much at all. What mattered was that suddenly you could take a credit card online, and the process of going from I sell widgets, oh wait, how do I do that, to I sell widgets and I can process cards and ship them to somebody who's been confirmed good funds, unlocked a lot of value of the internet. And at the same time, personally, so I wasn't born in the U.S., came to America as a 16-year-old, and from Soviet Union. So my brain was switched onto capitalism at a relatively late age, and I was brimming with libertarian energy. I thought, my goodness, what could be better than enabling purchasing, consumption, greasing the wheels of commerce like that? That is the most amazing thing to do. Fast forward 20 years, I've been in the U.S. for quite a lot longer. I have 2 kids, and my view of the world has shifted where at PayPal, I cared very little for the downstream societal or social consequences of the products I built. I just loved the fact that we were creating momentum and increasing velocity of money, to probably use a Fed familiar term. These days, I spend a lot more of my time asking the questions like, is this good for the world? Are we actually making something that improves society? Are we shifting the narrative from pure capitalism to responsible capitalism? And I don't think it's something that one company can do, but we feel very strongly, or I feel certainly very strongly, that companies I start these days have a responsibility to the world, responsibility to society, and try to both lead the way and do something very tangible. And so as a result, PayPal, sort of back to the market perspective, was all about taking something that was built really in the 70s, the venerable Visa, MasterCard networks, and putting a really nice veneer on top of it. We essentially took something that lived on green screens, sort of giant computers in the backs of large issuing banks, and put a really nice API over it. It was real time. It played some interesting, clever games where things that weren't, for example, I'm sure most people in the room know, so the off capture settle model, and a lot of these things are not really real time. PayPal made some of those appear real time, but there wasn't a whole lot of innovation below the rails. A firm came at similar problems, actually, with very different point of view, essentially saying, for us to change the world, to make a real dent in people's lives, we have to rethink the entire system. So we need to go back all the way down to the question of what is the best way to borrow money for a consumer. Every transaction is a credit transaction. It doesn't matter if you're settling in 30 seconds or 30 days. Ultimately, every one of these things is a matter of trust, and the question that we wanted to answer, what is the best way of wrapping this trust in dollars? And so today I think about my products very, very differently, but practically I think I'm basically still solving the same problem over and over again.
So can you talk some about how the environment has changed, the regulatory environment and just the business environment between PayPal, stand-up, and a firm half a dozen years ago?
Sure. The watershed moment was 9/11. I think before 9/11, you could almost get away with moving money without having a money transmission license, which today seems like someone will come in with handcuffs open and ready to take you away. And we were naive, we were younger, we didn't really understand all that much, but before Patriot Act 1 and its follow-ons and all the sort of acts that came after, the world was a much simpler place. You could actually consider yourself more or less on the margins of the law because very little law had been written, and the one that was written, it was still, things like terrorist finance were just not common narrative. Like today, you open a credit card agreement, as you're signing up, the first line typically says, to assist the United States government in its battle against international terrorism finance. Here's why we're asking you all these Bank Secrecy Act questions and AML and all that good stuff. And 1999, none of this existed for 2 more years. Just some stats. I think we brought on our first lawyer, like a general counsel for PayPal, don't want to perjure myself here, but I have to believe John Mueller, who just very recently left, who's a wonderful, probably one of the foremost minds in payments law, must have been sub 100, but thereabouts. We had brought on a GC at a firm, I think as employee number 7. So just gives you a sense for how I thought about it 20 years ago, how I thought about it 7 years ago. Very proud to say that my now sadly former GC is the newly sworn in commissioner for Department of Business Oversight of California. So not only did we bring on an amazing lawyer, we also graduated him to a government job of extreme importance, certainly in our home state. But that certainly changed in an extremely visible way. 20 years ago, the idea of regulators was something that you just sort of try to stay away from, and if they don't know you exist, maybe they won't come and annoy you too much. These days, the mantra that on day one when we started a firm, I basically said, look, there's only 2 ways. You can be at the table or on the menu, and so you gotta be at the table. So we engaged with everyone from fair trade to federal trade, to CFPB, to OCC, to every one of these guys have now set up an innovation office that you can actually go and say, hey, here's who we are, here's what we do. It helps that we have an extremely mission-driven company, so we're trying to do something good. But even if you're just a financial services company, today you don't exist without regulators being right there next to you. And you can hide, but you can't really run. So it makes a lot of sense to engage, and that's certainly what we did. But I think that's true of every fintech at this point that knows what's good for them. The most interesting thing that changed, and again, sort of goes back to sort of PayPal versus the firm comparison, PayPal, if you step far enough back and say, what was the day one advantage? How did we, what possessed the world to say a non-bank payment rail, that by the way sat on top of bank payment rail, deserves to live? And the answer is, well, the user interface sucked before we came along. Credit card's actually pretty nice. Back in the day, you swipe a card and a transaction happens, and you don't really think too hard about what happens. Online, it was like, well, hang on a second, we got a check on delivery. That was a big thing before PayPal. And today, user interface doesn't suck so bad at all. My cards in my pocket all have apps that come with them. Those are pretty good apps. They hire the same people I would like to hire for the apps that we build. And so the innovation at the user interface level is no longer enough, and it's not that interesting or even meaningful for consumers. Everybody expects your app to be quick and responsive and high quality, work on every possible mobile platform. It has to provide value above and beyond traditional financial institutions, and that's sort of the crux of fintech. I don't know if it's 2.0, 3.0, or whatever it is. It's fundamentally all about, can you exceed the value that you could find in your traditional bank?
So much of this conference has been about, if you will, the macro level, the legal and policy side. I want to take it down to the consumer side and how it looks from that side of the transaction. Could you share your take? What does all this mean, and particularly in the context of a firm, which is credit, and I understand you've got some additional aspects that you're adding. How do they fit into this, and what are your goals in delivering to the consumer?
So one of the trends that I think waves, if you will, that a firm has been surfing successfully for the last almost 8 years now, the new generations, which used to be the millennial, and now there's a whole bunch of people after them that are rapidly coming of legal age and represent a meaningful part of the economy, there's a real change in how they think about money and banking and financial services. And the one word, sort of what is required, is transparency. And it's a tired word. Plenty of people out there say, yawn, okay, sure, transparency, fine, we have that checkbox too. And it is not that simple. It is something that you actually have to build products around, because people have lots of alternatives now, and they will choose a product they can understand better. And this notion of make my life simple, I only have 10 seconds because of Twitter, because of social media, because all the things are becoming bite-sized. Context switching is expensive. If I can't understand what's going on my screen, I'll just postpone it. And so a core reason for a firm to exist is because lots and lots of millennials are opting out of credit cards or not using credit cards the way their parents did, because it's hard to understand. You swipe your card, Are you out of open to buy? Will you revolve? What's the fees? Is there insufficient funds on the checking account side if you're trying to pay your bill? So that, something that I would explain to my mom, who would say, nah, you know, it works fine. I pay it off at the end of the month. It's no big deal. So I explained to my brother, who is a bit younger and is in fact sort of at the older stage of the millennial group, he is extremely averse to using his credit card. Funny enough, all three of us came to the US in exactly the same, none of us grew up here, obviously, and my mom was the most American of us all. Although she came in here as a fully grown adult, she's like, oh yeah, love my credit card, just pay it off at the end of the month, don't have to think about it. There's something in the fine print, but I don't have the time to read it. While my brother refuses to read the fine print because he thinks it's out to screw him. And basically says, look, it's a debit card. In fact, it's on my line, although I wish I came up with this, but one of our investors said, great disruption is coming for all companies whose business model is in the fine print. I think there's an extremely good way of summarizing what is happening in fintech right now. There are a lot of companies whose business model is in the fine print. If you look very carefully, credit cards are one of the world's least interesting, least efficient ways of borrowing money. They only offer you two rates. You only are aware of one, it's the headline APR rate, but there's a second rate for cash advances, and that's the fine print business model where, oh, you need the cash, no problem. It is $29.99, but nobody has to know. And then a few other ones.
Plus maybe 1 to 5% up front.
Of course, why wouldn't you? And it's all in a small print if you want it on the other side of the page that you forgot because it's not in the main part of the statement. And so I think all of that, with some pushing from the companies like Affirm and consumer sentiment shifting, is coming to an end. And I think that is a great thing because a lot of inefficiency in the economy lives in a form of late fees and insufficient fund fees and God knows what other kinds of fees. And that is changing in consumers' mind, consumers' expectations, and we're there to answer that call, but I think many companies are as well. And so that is probably the most important driving factor for how we think about our product design, how we think what works, what doesn't for consumers. It has a lot of really interesting implications. I can go on about this for quite some time because I spent most of my time thinking through these things. But for example, the ideal sort of version of a financing product, and so Affirm, for those of you who don't know, is in the point of sale finance business, which is if you're buying a Peloton bike online, you will find yourself either able to pay cash, and by cash I mean anything that settles very quickly, as in my mom's version of just pay it off at the end of the month, pay no interest, or you can finance it with Affirm. So it happens that Peloton, the price of money, as in the interest that will go for, I think the standard duration there is, or standard term there is 39 months. You'll pay $0 of interest. There's actually no interest at all. This is not that audience, but I'll say it anyway because it sounds really great. Anytime somebody promises you a 0% financing product, they're lying. The only thing you can know that it is not going to be 0%. Like there is fine print, and that is the business model. The 0%, and then we'll go back in time and reclaw the deferred interest. Time-tried way to screw consumers, and I will not stand for it. But there's one exception. If you see 0% financing from Affirm, it is in fact 0%. Like, in fact, you can be late, and we will not charge you late fees, and we will not change your interest rate. It'll still be 0. In fact, you can default, and we'll lose money on the loan, but we will not charge you anything beyond whatever you've paid us. And so that level of consumer interaction superficially sounds like, okay, fine, you're willing to take a loss on these things because you want to maintain a great brand and consumer experience, but we do. But underneath that, there's a lot of financial design that has to take place. For example, if you're going to guarantee people a certain number, be it 0 or 1 or 10, whatever, it has to work both in rates and dollars. Otherwise, you're confusing them again. So you have to be able to commit to a dollar number as well as a rate. Means you can't charge fees. That means it has to be a simple interest loan, not compounding. It has to cap out the interest past the number that you promised. So there's a whole bunch of little wrinkles to financial products. Before you're done with it, you realize that you've built something that the industry hasn't seen before. And that's where I think it's all headed, where you have to build these completely different products that are fundamentally designed to eliminate the fine print as the business model and answer this need for consumer trust, because a lot of people are coming into it saying, I know my bank is out to get me. Like, they're not on my side. There's a great study, actually the origin story of every startup has lots of wrinkles to it that get ironed out and turn into sort of beautiful one-liner like Pez dispensers and eBay. It's a little bit more complex than that. But I haven't gotten to the Affirm one, so it's not ironed out. And there are many different strands that sort of weaved into Affirm. One of them was that I read this study called the Millennial Disruption Index. And it surveyed 10,000 millennials, which at the time they were still 13-year-olds, and this is quite some time ago, and there's a whole bunch of really, really valuable stuff in that study. The most interesting piece was that they rank ordered brands that they planned to bank with when they were of age. And the top three were Google, Facebook, and not Amazon, someone else, but the old .com companies. And so, something like that. This is long enough ago where Amazon was not yet obviously going into financial services too. But that sort of struck me as like, wow, so they didn't name any one of the venerable banks as like, at least someone might expect to bank with Bank of America. It's been around a little while. And no, there's like all these .coms that were going to be that generation's banks. And so that alone was sort of like, wow, like these people clearly do not believe their parents' banks are good enough for them. And so that's a lot of that's a lot to absorb as a fintech entrepreneur.
It's interesting. We work with a lot of the large banks, and almost, I think for every one of them, they answer that question the same way. They see their greatest risk, greatest competitors as not other banks, but rather fintech disruption from the major tech companies. So I think you've shared a lot on the product, and the other part of that is how do you match it up with the customers, determine who it's suited for, who that model works with. There's talk about how do you discover the invisible prime. Right. I think that's less of a slice of the unserved market than maybe those are the ones that have, if you will, the easiest happy ending when you find them. So can you share your thoughts on what you've done about how you match up consumers that the product works with?
So the distribution model for us from day one has been partnership with merchants. So we would go to Peloton, I think we launched with them when they launched their product, all the way out to Walmart, which is our largest partner, and thousands of merchants in between. And so as a result, our customers are their customers. And the part of how this thing works is, of course, we have to build our own underwriting system, our own scoring. One of the key other strands, narratives in the very beginnings of Affirm was that even as far back as PayPal, I'd always eyed FICO suspiciously, and back then I think it was like FICO, I don't know, 4. These days I'm sure they're up to 8 or 9. It was, it seemed like it was pretty limited because, true story, so come to the 2016 pre-card act, get my first credit card on campus and a free t-shirt. And back then it was okay, not so much now, which is a good thing because promptly I get the entrepreneur bug, start a company, realize that I'm entirely out of cash, too proud to ask my immigrant parents for anything. So, well, this credit card thing is wonderful, I'm just going to use that. So I financed my first failed company out of, PayPal was not my first company, by the way, it's my 5th company. The previous 4 have less known endings, but they're exactly the same. Let you guess what they are. But by the time the first company failed, my credit card was maxed out, and my credit score was in the 500s because I had no idea that you have to make a minimum payment to remain at least something of a good standing. Well, it might stand to reason that a 16-year-old Soviet immigrant might not fully grasp the credit card system, but that's a separate story. I then got a call from a real collector who read me the riot act, and I said, I swear to you, I will pay you back the second I have any money at all, but currently I am roughly negative $200. And the person said, sure, whatever. I've since paid them off and have never been late on another bill. But the day after PayPal IPO, I tried to buy a car and was denied loan. And the guy at the dealership who told me, I'm not lending money to you, man, your FICO score is still in the 500s, you don't understand how bad that is, also knew who I was and said, I read today you guys took your company public. And said, yeah, I'd like to own a car now that we did fine. I said, no, sorry, that's not possible. You have to pay cash. And so I turned around and borrowed some money from one of the less financially irresponsible 24-year-olds in the PayPal team and paid cash for a car. Now, that goes to the, how do you discover hidden prime? I hope FICO people not in the audience with, vegetables ready, but maybe use a better credit scoring system that accounts for things like I go into student debt, I trash my credit score by using credit cards to start a company, I start a company that actually succeeds and do fine, and my FICO score is still, in fact, on the 10th anniversary of the PayPal IPO, our long then not CFO, but CFO, the guy who took us public as a CFO, conspired with a sushi restaurant we went to decline my credit card because the history of my bumps in the credit road were so well known to the PayPal team. And so the hidden prime is not quite as uncommon. So immigrants and people that go through a lot of student debt and just don't understand how to manage their money because they go to a great school and their parents are paying for it. And then suddenly they wake up with a computer science degree and they're employed, Goldman Sachs or Google, they make, almost 7 digits on day one. They're fantastic risks, and their FICO score at best is 650 because it's just undefined. They've never borrowed money in the first place. And so there's an easy fix for that. If you understand their cash flow, or you can estimate it well enough, you can pick up a lot of that would-be prime or soon-to-be super prime. And we do some of that at a firm. The trade-off there is the complexity of the user experience with the quality of the service that you get. Telling someone, please log into your bank account, let me see your cash flow, and going back 6 months, I know you're good, is a big lift. For someone who feels like they've been denied credit unfairly, that actually would do it. But you have to figure out that that person is in fact in that position in their life where they're like, I know I'm a good customer. So my righteous rage at the dealership in Los Angeles was completely justified. If he had said, look, just show me your bank account statement, I'll give you a loan, I would have done it. So knowing when that moment is actually a very, very important thing. On the other side, so about between a third and a 40% of our business is these merchant subsidized loans. So when the magical 0% loan is not magical, of course. It's the merchant, they're fully integrated. So the manufacturing and retail single company, they have a ton of gross margin. They're more than willing to pay down some or all of the interest rate the consumer would incur. Those are wonderful products. They're true 0% loans. We're very, very excited with them. Not everybody has the same level of integration. Many, many resellers or broadline merchants partner with us as well. In that situation, they don't have the margin to offer, so the consumer ends up paying a fair risk-based price. In that situation, of course, that product caters to people that are saying, my credit card is probably already half utilized. I'm not excited about maxing it out because unlike my fully fungible credit limit, this is a purpose-built loan. We're always lending money to a mattress buyer for a mattress, to a bicycle buyer for a bicycle, which means the cash changes hands, or the money changes hands. We settled with the merchant, and every time, by the way, I say we, sort of stepping back for a second, it's a bank partner model, so there's a bank in New Jersey that actually does the transfer. We are not a money transmitter in this situation. But it is a great product for a lot of folks that are responsible enough, but are not well-to-do. And we actually you can see the bimodal distribution where the sort of your typical upper middle class probably finds a firm kind of hard to understand, like why would you use that sort of thing? If I use my credit card, I get my United miles. But the mile chasers are not our customers. It's the people that are enjoying the 0% buy down from the merchant, or the people that are say, this is great. I have this very clear purpose-built financial vehicle that was created for this item, and I don't need to worry what that does to my open to buy, because that's the $400 that most Americans don't have to spend in a family emergency. It's in the form of a credit card. Like that's where that $400 lives. I warned you that I tend to meander into topics of interest, so I stopped myself.
This is going well. Well, let me shift. So one challenge in alternative underwriting is, and particularly if it's AI or machine learning or big data, is how do you prevent an unnecessary discriminatory impact? And that's something I think it's one of the big questions that the whole industry, the whole regulatory body, the lawmakers are wrestling with. What are your thoughts on that?
Super important. Obviously, you can't be a mission-driven company and sort of say, but we're not responsible for what the machines have done to the world. So we take it more than seriously. We do a ton of internal studies, like how well have our models done in terms of any form of discriminatory. We're subject to all the same regs that a traditional bank would be. So UDAP and all that stuff really, really matters to us. One important thing to disclaim, and I think there are some CFPB folks in the room, so if I have met you in my brief trip through the CFPB advisory board, you know that I have come into CFPB a couple of times to teach, do a sort of day teach-in that black box underwriting is not actually all that black box. You can't understand it. I mean, there's some parts of machine learning that are too complex to fully grasp, but in most cases, it is a lazy person's way out to say, oh, you know, it's black box. It is absolutely explainable. There's a whole industry of startups now that will explain a model to you. A machine will read a machine model and spell it out, like here's what's really going on under the covers. But practically speaking, what we do is, should go without saying, hopefully, that we don't use variables, are very, very careful not to touch anything that would remotely correlate to a prohibited basis. That's sort of the baseline. That's not really enough because you're still going to find yourself at risk of inadvertently causing discriminatory impact. And so what we do is we do back-end validation of all of our models, asking questions. And you can infer a fair amount of prohibited basis just by examining the sample of the user base and saying, well, does this correlate too closely? And then you take out variables. And you maybe would have found some interesting pickup somewhere, but it's more valuable to make sure that you don't have any sort of discriminatory action. And then, on top of that, we have an entire separate third-party program that we bring in an external auditor where we hand off our models and hand off our data to and say, we think this is not discriminatory, or this is within the margins that we are comfortable with. Are you comfortable with it? And tell us if we missed something. We do that. And then, because it's a bank partner model, ultimately, the bank also has to have a model, has to approve the loan that we have found the customer for. The bank is the one that's signing the paper on which the loan is made, so they too have to approve it. So we feel quite good about the level of effort we're putting in, but it's something that from the mission point of view, we spend a ton of our time thinking about and caring about. And in general, I feel like a lot of the fintech world has gotten religion around this now. I think if you looked 20 years ago, sort of the libertarian Max would have said, I am greasing the wheels of commerce, people are getting approved, good stuff, and don't worry about that. And 20 years later, with more of a, what do I want the world to be like for my kids, I feel a lot more passionate about, like, hey, I want to make sure that we're actually bringing in people to credit access where they would normally perhaps be declined for the wrong reasons, or they wouldn't be given the same level of fair chance. And so it's something that we really care about, and I feel like we're not the only ones by far these days.
So going to the regulation, and we just had a panel earlier this morning about this. One of the perennial topics at these conferences is the relationship between state and federal regulation and the challenges that provides, but also the goals that the states have. What's your take on how do you balance those?
Our CFO, I recently tried to insult him by calling him champion in design thinking, which is instead of saying no but, you're supposed to say yes and. Whether I like it or not, it's very much a yes and in the world of federal and state regulation. I think you have, depending on the administration, depending on who is in what office this time of electoral cycle, you have very strongly opinionated federal regulators or state regulators, sometimes both, but it's a guarantee that you'll ever have neither. And so at a certain scale, which a firm certainly is at, you have to engage with both, and you have to be very mindful of what they care about, what matters to them, what matters to their constituents. I think, there's a standard fintech ask, but I think it's a real one. There's just enough regulatory uncertainty in the touch points between federal and states that would be wonderful to resolve. The perennial Madden Midland issue, for example, comes to mind, where it'd be great to have an answer as to what that means, and that's a classic federal versus state limbo, for lack of a better term. Several other ones as well, but in the end, I think at a certain scale, we live in this wonderful experiment in democracy, and it gives states a lot of rights, and their local lawmakers and law enforcement organizations care a lot for their constituents, so you either ignore them or you will you engage with them. At the table on the menu dichotomy applies at any regulatory level, including state.
I think that's good advice. And I think everybody knows Madden Midland and question of whether a purchaser of loans or collector of loans that is not a depository with preemption rights, whether they can continue to charge interest above a state level. And we could spend the morning on that one.
I am far and away not an expert in that matter, so probably not with me, but I care about which way it gets decided.
Well, I want to shift and then go to some questions from the audience to the broader market. Fortunately, indications are that the risk of a sudden or severe downturn seem moderated at this point. People are pretty optimistic. But an often repeated comment about the fintech world is many of the companies have not been through a business cycle. What are your thoughts about the challenges that will happen, and will there be a shakeout even through, say, normal business cycle?
Oh, they're absolutely going to be a shakeout. Like that, I think that's the only thing we know from the U.S. macroeconomic point of view is we're 12 years closer to a recession. That's self-apparent. And so I think at some point, any fintech CEO, yours truly included, saying from stage or in private, don't worry about it, we'll survive a downturn, no big deal, is fooling themselves or fooling you or both. But you only get to find out how good your underwriting and your servicing skills are. By the way, one other thing that we did with a firm, from the very beginning, we basically said, step one, we must own every step of the way. Our consumer satisfaction scores are the highest in the industry, which is something of great pride for me. Typical net promoter score for a card issuing bank is about -1, -5, which means more people recommend that friends don't use the product than use the product, which is quite an achievement. In a firm's case, the score is 83. The only one I know that's higher is Tesla's, and that's a religious cult. And so I think you can't put a price on that. But our customers love us. We think they will continue prioritizing our bills even as their personal financial situation becomes a little bit tighter. But we'll find out. And I think there are two separate things, or maybe three separate things. There is the construction of the portfolio. How do you think of the loans you're making? For a very long time, we made 100% of our loans on our own balance sheet, where we would retain the loan we would buy it back from the bank that actually wrote the loan, of course. We would take it onto our balance sheet and lived it out all the way until a charge-off or a full repayment. At some point, it got big enough where we started very carefully finding buyers that would buy these loans, but we would still retain 100% of all the servicing relationships, and just to make sure that the consumer gets the same consistent experience all the way through and continues to enjoy the product that we've created for them. So we feel very good about, are we going to be able to do the right thing by our customers while reminding them perhaps a little bit, we may have to remind more of them that the bill is due. Second level, of course, is the question, how durable is your underwriting? You think you're a genius when the economy is expanding very rapidly. What do you think of yourself when people are saying it's either this or my cell phone bill, and I need my cell phone more? And so we'll find out. One of the mitigating factors for companies like Affirm, the durations are short, and so you can react to the fact that things are changing in your portfolio a lot quicker. If you sort of issued a bunch of loans and you're sitting on a 30-year receivable and consumer base is unhappy, there's nothing you can really do about that other than try to settle with them, which is, that didn't really work well during the Great Recession. And so I think we feel good about that. The most tenuous, if you will, and again, I'm being honest as opposed to marketing-centric perhaps, is the back-end relationships. As a non-bank, we have to borrow money to lend it. And so today we enjoy wonderful, very close, I think it's currently active, call it 5 warehouse lines where we take our receivables and finance with very large, very successful depositories. I have been around long enough to know that during 07, 08 timeframe, those very depositories called their non-bank lending partners and said, I'm cutting you off, love your product, love you, we go way back, but hey, look what's going on outside. I can't have this. You got 30 days. Figure it out. Unwind. And so, depending on the severity of the recession, depending on what actually happens in the market, you have to believe that these relationships are strong enough based on a performance. If your performance have been excellent, which in our case, I'm not superstitious, but it's always worth buying insurance. We've done well enough where we feel very good about the state of our relationships, but ask me again when we're out of the trough. But I think that the real shakedown or shakeout in the industry will happen primarily on a shorter duration side of things on the capital partnership side. Companies I worry the most about are the ones that are not, intelligent enough to say things like, what's the ratio between my excess spread or my return on asset versus my current net adjusted charge-offs? If you're not doing that math in your head every other day, you're not doing it right, because an overnight increase in defaults to the tune of 30%, which happened during the crisis, which no one's ever heard of except 07, 08 timeframe, could happen again. And then if your loans are upside down, that's when the capital partners say, your loans are upside down, you're never gonna get paid, I'm out of here. And so that's the nightmare scenario for a lot of folks. We stress test ourselves, and I hope everybody else in fintech world does as well. And I know a bunch of companies, by the way, this is not unique to Affirm at all. But plenty of people who are very grown up about managing their book, or even the book they sell, just to make sure that the buyers continue coming.
I think we have folks with microphones and a few questions, time for a few questions here from the audience.
Hi, Peter Renton, Lender Fintech. You said, Max, that your distribution model has been through merchants, and I saw that you released your new app, which allows people to use Affirm now at anywhere. I think it's a really interesting innovation. Do you see that as a driving force for use going forward? Because it feels like to me that's a totally different distribution model, right?
It's not a different distribution model. So in a sense that the product is generally available to people that have used Affirm before. So it's a little bit more of a clever hack where we said, look, Affirm is not yet available at every merchant, but you should be able to use it anywhere. So to the consumer, Affirm anywhere loans look just like a regular loan. To the merchant, it settles over existing rails that they have integration with. But the product is fundamentally aimed at someone we've underwritten, we understand. This is not if you're not careful, it starts taking on characteristics of a cash loan, which is a completely different risk profile.
So you're not trying to attract new customers with that product?
Last thing I want to do is promise my product strategy revelations, but at the moment the answer is no.
Okay, thanks.
Hi, Andrew Marquardt, Middle March Partners. Can you go back to your comments about the liquidity? And there are a lot of, alt lenders out there that have these bank partnerships in the back end. But one of the concerns should be, sort of the next crisis not only being a credit crisis, but also a liquidity crisis. How do you think about the potential or the optionality of you or others thinking about actually going down the path of getting your own bank charter to get your own core funding?
That is a topic that could easily be spent a morning or several mornings on. I think it's no secret that there's a whole bunch of fintechs, at least one publicly traded and one from Japan and one from Germany, last I checked, who are all basically saying, look, the only way you get insurance in this world is deposits, and not to, I realize that there's some hidden pun on Federal Depository Insurance Corporation in there, but what I mean is insurance against running out of liquidity, running out of access to capital, is you ultimately take deposits from your customers. And you can't do that in this country, rightly so, without having a bank charter. So there's plenty of people saying, well, fine, give me a bank charter. There's some real restrictions that you end up having as a bank holding company act subject to that particular act. And so the only charter, or at least the charter that people are most excited about, is the industrial loan company one. Those have not been minted in quite some time. The most recent attempt was, if I remember correctly, was Walmart that was promptly sued. The attempt was sued out of existence. And so practically speaking, I think that's a conversation that everyone is having. And FDIC is, I think, on the record saying that their job is to make new banks appear. That said, you have to qualify. And I haven't seen anyone qualify just yet. So I think it remains an extremely exciting theoretical possibility for a bunch of people that are sort of either at scale or approaching scale. But it's a little naive to use that as the hey, that's what's going to happen to everyone. My guess is FDIC is going to be extremely thoughtful about who gets a charter. They cannot be an embarrassment, especially if it's a fintech company and they promptly end up having problems. That cannot be something that they couldn't allow that to exist, I'm sure. And so it's probably a watch this space sort of thing versus I know what's going to happen next. But nothing would excite me more, by the way, than someone getting a real charter under the auspices of FDIC, because I think that creates a real answer that these companies, kind of like a firm, deserve to participate in the big voice system. And so I think
Is that something that you're thinking about for a firm?
Thinking and acting are very, very different things. I would lie if I said I haven't thought about long and hard. It's the kind of thing that you have to think very hard about and then think again before you do something.
I think maybe time for one or two more.
This is Wei Zhang from CAPB. It seems to me you offer a very compelling product where zero is true zero versus the options, the deferred interest option I think you're talking about, where zero actually is not until consumer does X and Y, Z. So I'm just curious, even still today, the deferred interest is the dominant product at point of sale financing. So I'm just curious, what kind of obstacles out there that prevent you from offering your product? This is my question, number one. Number two is, there's some car companies actually offer some kind of payment flexibility where, for example, I bought a piece of sofa. Now I can make decision. I want to pay this sofa in the next 6 months in a fixed payment option. Seems to me that's a direct competition for your product. So I just curious, what's your view on those features?
We're rapidly in the sort of the weeds of the product we offer, so I'll try to answer at a general level, but it obviously something that I spend a lot of my time thinking about. So the obstacle or the distribution limiter to a firm is how many merchants can we sign. In some cases, merchants are large and they have other priorities and they think would be amazing. So a typical merchant will experience a double-digit growth overnight of volume and a significant improvement in the average ticket when a firm is introduced. The word that pops out of every customer survey that we run after the fact is control. The millennial consumer basically says, look, I get a sense of control. I know when I'm done paying. Like, it's as simple as that. Not revolving, I have 6 installments and then I'm done. It's the sort of the subscription economy playing out in a form of larger purchases. So we've proven our case. There's gazillion case studies that we've shown that it works, from sports equipment to homewares to anything you can possibly imagine. But there are plenty of merchants that have not yet implemented us because it's not a switch you can flip overnight. You actually have to invest a little bit in it. I'll get on my horse of things that I hate about financial services for 10 seconds or 15 seconds or less. But one thing that I think lawmakers or regulators or someone in this country should do is figure out how to put a stake through the heart of deferred interest. I think the most evil thing that's ever happened to consumers in this country. Like, I have far less pain in my gut over things like triple-digit rates, which I think are terrible, and we've loudly supported California has now a new rule that says 36 or lower, which is wonderful. But in the end, if I had one bullet to fire in bad financial products out there, I would kill deferred interest. The ability to give somebody a 0% loan for 144 months, and then you're a day late or $1 short, and you go back 12 years and compound at $29.99, and then expect the repayment is evil. And I think it should not exist. It's been outlawed a couple times. People keep on figuring out ways of rewriting the rules to okay it. And sadly, a fair number of merchants see that as a revenue opportunity because they understand that the banks that issue these kind of products are quite profitable on the strength of the deferred interest and the late fees that are embedded in it. So that's another deterrent, and I think eventually, the good news is that consumers are smarter and smarter every day, and they will have nothing like this eventually, but not all of them, and many people fall for the allure of the 0% that isn't true. other thing that you mentioned, that now a bunch of card issuing, and these issuers are not not your typical point of sale issuer. So this is Chase Pay It. Sorry, that's Amex Pay It, Planet Pay It. Chase has a My Chase plan. There's 4 or 5 of these now that are out there. I think it's awesome. Like basically, and this is a lesser hobby horse as far as these things go, but I think consumers generally should think twice or maybe more times before they got onto a revolver of any kind. Revolving credit is a great product, but it's hard to manage, and people have a very hard time computing exponential functions. It's just hard to predict in the mind of someone who's busy running their day-to-day life. And so the fact that these card issuing banks are essentially saying, you know what, some of your spend doesn't have to live in this revolver. We're going to convert it into effectively a simple interest loan right alongside the revolver, I think is wonderful. Like ultimately, fintech and financial services writ large it's not an industry that trends towards monopolies, which is great news. And that means, I have no doubt that Chase and Bank of America, despite the millennial sentiment towards Google and Amazon, will be around 100 years from now and hopefully for a very long time if they take up the religion of let's give people simple products that don't make money on late fees, that don't rip them off, that God forbid do deferred interest. That's great. I think that would be a wonderful thing. And you can do better. You don't have to charge late fees. We don't. But even just elimination of revolving credit or revolving interest accrual is a wonderful thing. So in general, all those things are great. I see them as positive developments for the industry, and I'm happy to compete in that space and come up with better products. But directionally, it's a good thing for the world.
And then we have one last question I would add in that context. A challenge those companies have that you don't have is they are cannibalizing their high margin revolving business when they divert people into those installment.
Right, which is why they deserve applause, at least to the degree that they're willing to say, yep. I mean, when we launched the firm, somebody was asking me, one of the very, very first investors asked, so you basically guys are building something that makes money like a regular bank, but just less margin. I said, yep, that is exactly the plan. Like, I actually would like to feel good about my lending business when I go to bed at night, and part of it is just not ripping people off by small print business models. And that's what we've built, and it's great. And I think the fact that people that have the burden of public multiples and all the other stuff that makes them think twice before they cannibalize their own margins and are choosing to do so speaks to the market demand. People are asking for better products, which I think is great. But also these companies are brave, and they're telling their public shareholders, you know what, we're going to do the right thing. So I think that's generally very good.
One last question here.
Thank you very much. Eldar Beyseitov here. I'm an economist with the St. Louis Fed and a fellow immigrant from Soviet Union.
Excellent.
I always thought that I've done well for myself, but now I feel like I need some work to do. Staying on the communist theme here, over the last couple of days, we've heard a lot of concerns, I guess, about the rapid developments, technological developments in China, specifically in fintech also. I personally believe that American tech firms have sufficient brain power to compete with China, but I'm not exactly an unbiased reviewer here, I guess. So what is your opinion on what we're seeing there and what kind of implications it has here?
That's another extremely hefty topic worth coverage. So I've sort of been watching China as a tech platform for a long time now. And the one thing that's worth stating, so first of all, I'm a card-carrying patriot with all sorts of crazy stories to share on that topic. But that said, I'm a realist. And 15 years ago, maybe 12 years ago, whenever I went to China first, my impression going back was, no new original ideas happen here. Like, this is a great place of cheap labor, lots of highly intelligent people, eagerly awaiting cues for what to do next. About 7 or 8 years ago, I saw the first company that was uniquely different. It was a Chinese invention. It was nothing to do with fintech, just a new idea that somebody was pitching to me as an investment. I thought, I've never seen anything like this in the world. Like, this is a completely original concept that speaks to the Chinese consumer, built by a Chinese entrepreneur. Today, 2/3 of the companies I see in China that are worth looking at in detail are completely original concepts. So the product innovation spirit, skill set, whatever it is, has caught on. And so you can't dismiss China anymore as a place where ideas go to be cloned. In fact, some of the ideas that we pick up as we study the world now come from China. So when we look at financial service products, we study Alipay and WePay extensively as opposed to thinking that they're just going to clone us. Since your place of employment warrants so a little bit, I would throw it back to you. I think one of the things that China has done quite successfully very recently is they have mobilized their regulators and their government functions to start thinking, what does it mean to have a true digital currency? Like US is still kind of muddling through this question of, can a private company, no names, be allowed to mint its own digital currency? That's crazy. We can't have that. Like, probably right. But the US government should be. And the Chinese government said, yeah, we're going to do that. And the US government has kind of sort of said maybe. And so I think that's where the opportunity is, but that's also where I would be most worried about. At the private company versus private company level, private sector, American entrepreneurship spirit has lots and lots of miles left in it. So I'm very comfortable there. But I do wonder whether US government and financial regulators, financial stabilizers of the system, central bankers, are thinking aggressively enough given the ambitions that you see coming out of the central government of China. So that would be I think that's the right cliffhanger to leave it on.
Please join me in thanking Max.